Welcome to Financial Strategies with Andrew and Daniel Agemy, powered by the Retirement Income Store and brought to you by Agemy Financial Strategies in Guilford, Connecticut and Denver, Colorado.
That at times like this, it makes me think about that quote from JP Morgan, not the company, the man, right? Nothing so undermines your financial judgment as the sight of your neighbor getting rich. And speculations, bubbles, these kinds of things are attractive to everybody, right?
Yeah.
A human emotion, the meme stocks things going on over the last, let's call it year and a half, 2 years, has been unbelievable. So much so that if we look back in history, we see the same types of things where Isaac Newton, one of the smartest people who ever existed, who's done so much for humanity, got caught up in the 1720 South Sea bubble. And it was this company that just could do no wrong. They were taking, shipping goods across the seas. They were lending money to governments. They were the biggest thing. They were amazing. And the story
Kind of like
goes,
Apple, huh?
the story goes, he invested in the company, made about doubled his money, and then thought the company was speculative and too expensive. So he got out of it. But then he couldn't bear seeing all of his neighbors and friends getting rich off of this company. And he got back into it. He got back into it at the high. And when the South Sea bubble crashed, he ended up losing the stories. Nobody knows exactly how much. Some people say he went bankrupt. Some people said he had other assets. He was still earning good income on other things and he made it. But he basically lost all his money in that company. Yeah. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy because people don't know what people don't know. And how are you going to know unless somebody tells you? So we're here to educate you on what's going on here. Today's topic is how life insurance really works. Well, Daniel, that's a interesting topic. I'm excited about today's topic, how life insurance really works, because so many times people don't know what they don't know when it comes to life insurance, right? So much is said about it, and in regard to what happened with Isaac Newton there, and your quote from JP Morgan, we see that going all around, right? Everybody wants to, houses are going up. So everybody wants to flip houses because that's what all the TV shows show. And that's where you can make money is flipping houses, right? But it's so speculative. And a lot of people have lost money in flipping houses. And you don't hear about those people. But I think kind of like the point is, if I'm not mistaken, is that's kind of like slow and steady wins the race. And and Sir Isaac Newton, from that standpoint, got involved with the emotions of it all and didn't win that race, at least with that company. Who knows what happened with the rest of his money? But I'm thinking that we're on the line with that, and that's where life insurance comes to be placed. Slow and steady wins the race. Is that what you're thinking?
Yeah, madness of crowds, right? Doing what the crowd thinks is not always the best situation. And back to Newton, right? It's claimed that he said he could calculate the motions of the heavens, but he couldn't calculate the madness of crowds. And that's how he got caught in that speculative bubble. And we talk a lot about diversification. We talk a lot about being positioned to take advantage of opportunities. And we talk a lot about preserving wealth, right? That's
Right.
what our company is founded and exists, is to help retirees protect the wealth. First off, grow it. Secondly, right? Support their lifestyle. But you can't support your lifestyle if you're not protecting your wealth.
Right.
That's what Newton found out. That's what JP Morgan was talking about in his quote. So we want to go through the good, the bad, and the ugly, right?
Yeah.
On
Right.
life insurance. We want to explain how it works, and we want to educate people on if this may be something that they should have, should not have, or if they need to reconsider and change the paradigm that they have on the words life insurance.
Exactly. Yeah, that's exactly the point. We use we've always talking here about definitions. Whenever we're defining things, educating people, it's important to be able to understand what does that word mean. And that's really what we want to define today is what is life insurance really? How does life insurance really work? And that's why I'm so excited about it because so many people have skewed, they either know nothing about it or they have skewed pictures of it. One of the reasons why we have a skewed picture of it is that one of the things that especially baby boomers did such a great job is that they baby boomers call death insurance life insurance, and that's not what we're talking about today. Baby boomers have made term insurance a very popular thing and very useful, but unfortunately it only pays upon death. And the actual
So that works. Term insurance would be you purchase it for a term. So 10 years,
period of time,
20 years, 30 years. And typically the premium is fixed. The death benefit is fixed for that period of time. So you buy $100,000 of death benefit. It costs you $100 a month for 10 years. At the end of 10 years, you're 10 years older. So it's going to jump up most likely.
Right.
You may have health conditions. You may have something else. You may not be insurable at the end of that period, but you get it for a period of time. It's like your car insurance. If you don't use it, right?
Yeah.
You don't die. All that money was paid and there's nothing left over. It just, it was insurance.
Yep. Right. You get a 10-year lease on it. You say it says that same place. You don't own the place, but you can use it for all that period of time. But then at the end of 10 years, if you want to stay there, well, guess what happens to the lease price? Goes up. And at the end of whatever lease you're on, you got nothing. But at least you got to use it, have that roof over your head during that time. At least you have the term life insurance death benefit over the period of time. So that's what baby boomers call life insurance, but it's really death insurance because it only pays upon death. It doesn't do anything for you during your life other than, cost you money. So we're going to talk about life insurance and what life insurance is. But before we do, I just want to let the people in the audience know that you're listening to Financial Strategies with Andrew and Daniel Agemy. And today's topic is how life insurance really works. And because people don't know what people don't know, we want you to understand before you do something or be able to evaluate what you have done in the past. Well, today we put together a paper that we think goes along with this succinctly, because especially for those baby boomers that are calling death insurance life insurance, they're thinking about death, and so we have this paper called Estate Planning, and it gives you some ideas of how to prepare, how to put together your estate in a way that will be the way that you want it to be. And everybody has an estate. If you have anything in your name, a bank account, checking account, car, anything, you have an estate that has to be settled upon your death. And that's what this is for, estate planning and how to be able to take care of that. We have a lot of options and opportunities for you on that side. But if you want that, call us at 800-725-7616. No obligation, 800-725-7616. And we'll be glad to do it. We need two forms of identification for you as far as phone number, address, email, whatever the case may be, so that we can verify that you want that we're going to send it to you in case something doesn't happen with that. But call us 800-725-7616. So let's get back into today's topic, how life insurance really works. So here, life insurance is given the name life insurance because when it was originally designed, it was for a person's life, their whole life, something that they could have benefits during their life, during their lifetime, that they could use the money in there if they wanted to. Sure, it pays upon death. There is a death benefit associated with it, but we're not talking about that. And that's not what the focus is, especially on today's show, because it's about helping people preserve their wealth and be able to have what they need to live the rest of their life. And so that's the true meaning of life insurance, is something that you can use for your life. We're always talking about the definition of an investment is something that pays you. And that's what true life insurance does, is pay you whether you live or whether you die or whether you go into a long-term care facility or whatever the case may be, or have a chronic illness or whatever the case may be. It pays you one way or another. So the money's coming back to you.
Right. And so it pays you living or in death, right? And so that's, I think, a real key thing. You and I, before we got on, were talking about how some of the guarantees, how the dividends work. And you told me that there's two ways that a specially designed life insurance contract works, right? Because there's a lot of them out there that are junk that you see that somebody sold, right? A product. It's a product somebody sold, and it wasn't designed. It was just sold, right?
Right.
This
It
is
was suitable.
this is difficult. The person who sold it might not understand it. You certainly didn't understand it. The person buying it. That's why it's dying now. And this is not what we're talking about. We're talking about specially designed, right?
Right.
So you were telling me on one of these specially designed is that it has a guaranteed value. So it's going to increase by a certain amount. And that's why you say it pays you, because you can look and you can see this is how it's going to increase each year, both the death benefit and the cash in the contract. But then on top of that, there's a dividend. And the dividend pays, and that's based upon how the environment is, the insurance company's doing, these kinds of things. Is that correct? Can you go in a little bit how that works?
Yeah. Well, first of all, before we get into that, when you're looking at life insurance companies, there's two kinds of companies, that you need to understand the difference between. One is stock insurance companies, okay, companies that are owned by stockholders. And so the policyholders, there's no big deal going on, right? Because the president of the company is a fiduciary for the stockholders of the company, and the company has to do well, not necessarily for the account holders, for the stockholders. Then there's the mutual companies that you're talking about, Daniel, when you're talking about these kinds of policies. Mutual companies are owned mutually by the policy holders. So basically, they're the stockholders. So when the company is working and making money, they're making money for the account holders. So very much like the difference between, fiduciary standard and a suitability standard, right? These are, a mutual company is working for the best interest of the account holders because they're the owners of the company, right? So like what we do with our clients, we're there to basically the owners of the company. They're who we're working for, and we're working for their best interests, just like in a mutual life insurance company. Well, that's a great place to start, because the difference between mutual companies and stock companies are huge when it comes to the types of policies that they issue. But I recognize that, look at this. Today's going fast, Daniel. I mean, it's already time for us to take a break, and I'm going to have to come back to that, after break. But listen, if you just joined us, you listen to Financial Strategies with Andrew and Daniel Agemy. Great topic today, how life insurance really works. And, even if you're listening to this and you sell life insurance, you're going to learn something today. So you hang on for your hats, man. So anyway, we got a book that we're giving out today by my friend John Moriarty, and it's called Understanding Specially Designed Life Insurance Contracts and How They Work. And this is a great book. It's easy read. It's only about a little over 100 pages from that standpoint. Easy read. It will tell you things that a lot of life insurance agents don't know. If you're a life insurance agent listening right now, you got to get this book, because you're going to get some education out of this thing that you don't have. I guarantee that. So anyway, with that, you can have this book for free. Calling 800-725-7616. So we're going to tell you a lot of stuff today on the show, but this is going to give you the in-between and the down and dirty, and especially if you're an analytical engineer or whatnot, or you can't believe the things that we're saying. Read this book, 800-725-7616. No obligation. We need a couple of ways of being able to contact you to make sure that you get it properly. 800-725-7616. Call now.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So Daniel, you were just a little guy back in 1993, but I had this client that owned a gas station back then and with a towing service, and he is probably like 53 years old at the time, and he was thinking another 10 years before he retired, and he was single guy, didn't have any responsibilities, but wanted to make sure that he was going to be in a good shape financially in retirement. And he had some other investments going on. Of course, he had the gas station that he could sell and all that kind of stuff. But we went through his portfolio and looked at different things, and he decided that the thing that would be in his best interest was going to be a 10-pay life insurance policy, one that he would pay the premiums for 10 years, and then it would be a paid-up policy. And he got that policy and he paid that policy religiously for the next 10 years. Well, now the guy is what? 70 something years old, and he's enjoying 9% a year growth in that policy, tax free. Tax free. So that's like, 11, 12, maybe 13% taxable he'd have to get to equal 9% tax free. So is he happy that he bought that back in 1990? You bet he is. He bought a specially designed life insurance policy to fit him. And he is enjoying it in retirement, taking out tax-free money out of that because he's in a high tax bracket. And every bit that he can get tax-free is for me. He likes that. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about how life insurance really works. That you had talked about earlier, it's called life insurance because it's for while you're alive. And people get mixed up between death insurance, which is just insurance in case you die, with life insurance. And the words have been, the definitions have been changed in people's minds.
Right.
So when they hear life insurance, they think of term insurance or something like this, where you pay for it for a period of time and you get a benefit if you die.
Right.
We're talking about how life insurance really works because this gives you benefits while you're living. And some of these, as we'll get into later, will give you benefits if you have chronic illnesses or you have to go into long-term care facilities or things like that, on top of the other benefits we've been talking about.
Yeah.
That story you told, that is ridiculous because, I mean, it's unbelievably ridiculous because I'm sure this gentleman did not understand how good that was going to be.
Exactly.
Like rates were going to come down.
Exactly.
At the time, it was like, well, those rates look okay, but like that's the S&P, which people are thrilled with, right? Over the last 20 years has done about 7.5%
taxable.
So, and you've had how many 40% drawdowns, 40% drawdowns in that time. So that's crazy. And like everything we talk about, these are strategies.
Right.
There's not one thing that fits everybody perfectly. That's ridiculous, right?
Right.
It's how you use these with other assets. It's how you use these to generate the income that you need in order to support the lifestyle that you want to have. It's how you use these to protect your wealth or help you build wealth. And we'll get into a little bit more how it can help you build wealth besides what you're talking about those 9% annualized rates of returns that it's been getting the last few years. How other ways it can help you build your wealth. So we ended the last segment on mutual companies versus non-mutual companies.
Mm-hmm. All right. So first, what I'd like to say before we get into that is that, this guy's getting 9% tax free because he bought it in 1993. Now, today, you're not going to get 9% tax free. And the longer you have it, the better that it makes. But, there's still huge returns that can be made for people. 3, 4, 5, 6%, 7% tax free is certainly available to people today. And, that is a big thing. But the difference between a stock company and mutual company and how their policies work are different. So we talked about how, stock company is working for the best interests of the stockholders, not the policyholders. A mutual company is working for the best interests of the policyholders because they're the owners of the company. So as a result of that, that's where a policy, a true life insurance policy, especially the designed life insurance policy with one of these companies, has guarantee values to it that you can count on no matter what. And then you get the bonus of the dividend that comes in. And the dividend is based upon the profits of the company and how well the company does. And most good mutual companies have paid a dividend just about every year, if not every year. Maybe they missed a year or two over the past 150 years or something, if they did. But that is very significant to what's happening with this. Now, from that aspect, the policies work differently, right? In a stock company, you don't have that growth, those guarantees. And what happened was in the 80s, stock companies saw that they couldn't compete with mutual companies in the same fashion. So they came up with a new thing, a new type of life insurance. So previous to that, there was term insurance and there was whole life insurance. Well, in the 80s, they came out with what's called universal life insurance. And so they took they took the risk off of the life insurance company and put it on policyholders. And they promised them, 8, 10, 12% return when interest rates were so high. And then when interest rates dropped, some of these policies have died before the people have died because they took the guarantees out of them. So some people in our audience might be saying, I don't like life insurance. Well, you got to understand what kind there are. Again, the definitions are important. So there's term insurance, there's universal life insurance, there's whole life insurance, and then there's variable life insurance. And variable life insurance took really the guarantees out and did some significant things that now you've got. It's just a crazy thing. I don't even want to talk about variable life insurance today. To me, that's not even worth my time. But
if you have a variable life insurance, you should probably get a second opinion on it. We'll say
exactly. Good point. Or even a universal, especially if it's an old universal. Some of the newer universal lives, they put guarantees in it, and basically what they've done is they've made them term for life. It's a low premium that you can have the rest of your life, so you'll always have death benefit, but there's no cash to you. Again, it's a death policy, not a life insurance policy, because the life insurance policies we're talking about have cash value to them that you can actually use during your lifetime. And man, I'm so excited today, Daniel. I just keep going on. Hey, you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And we want to educate you and help you to understand some things that you're not going to hear out there. You got talking heads all over the place trying to tell you what Wall Street wants you to hear, but this is stuff that Wall Street doesn't want you to hear because they don't make money on it. So today we're passing out a paper that goes along with today's show called Estate Planning. And this is going to help you to be able to understand how estate planning works. Sometimes people use these specialty life insurance policies for their estate planning needs. And, maybe we should give that example of one of our clients that does that, Daniel, at the beginning of the next hour, or quarter hour. But anyway, the point being is we got this paper for you for free, 800-725-7616. That's available for you, 800-725-7616. Call and ask for your free copy of estate planning. So anyway, I'm going crazy today, Daniel. I've had some coffee, and you're talking about a product that's near and dear to my heart, right? Let me just say this, right? Well, let's keep going. Stock company versus mutual company. The policy's growing. And as this money is growing for you, it's growing tax deferred, so you're not paying taxes as it's growing, so it's not hitting your tax return. It's growing in a way that is other than the stock market, so you don't have to worry about what the stock market is doing from that standpoint, and you have some actual guarantees. And some people say, the guarantees don't look very good. Well, compare them to your stock market account. They look phenomenal compared to your stock market account, right?
Yeah, you don't have any guarantees in a stock market account.
Right. So you could, not that you will, but you could lose all your money. And what the insurance contract's saying with the guarantees and saying, you're guaranteed this. You can depend upon this. This is contractually guaranteed. You can take this to the bank. And we like contracts. We like promises. Hope, well, Okay, hope is for a tiny piece, right? As you get into retirement, but contracts and promises are significant. But anyway, the money is grown on a tax-free, on a tax-deferred basis. You can take it out tax-free. You know, when is $1,000 not $1,000? When you have to pay tax on it. Um, this life insurance is one of the options, especially design life insurance, is one of the ways that we help clients stay up with inflation because it's growing faster than inflation from that standpoint. It's just a phenomenal thing. Daniel, I want you to talk because I'm just like going crazy. I got to calm myself
we
down.
call these things, a rich man or a rich person's Roth, right?
Right.
Because you can stuff a lot more money into these than you can a Roth. And when you look at the macro environment, when you look at government spending, right now, without what we just did for student loan repayments as a country, we're scheduled to run trillion-dollar deficits from now on, right?
Yeah.
So if we're running trillion-dollar deficits, that means taxes most likely are going to go up, not down, right? If we had extra money coming in tax receipts, we had all this money as a country, we could be lowering taxes, or we could be doing things to generate even more tax revenue by creating highways and bridges and productivity, right? We're going the other way around. So if you think taxes are going to go up in the future, then you need to look at these kinds of things. And Roths are a really good way to do that. This isn't a way you could get a lot more money in, and you don't necessarily have to pay taxes to get the money in, like in the same fashion you would if you were doing, say, Roth conversions.
Right. Good. Excellent point, Daniel. Excellent point. Roth lookalike on steroids is another name for this, or rich person's Roth, right? And it has some of the same advantages, the tax-free nature that the Roth has, but some of the limitations that the Roth has are off of it. Like Roth, you can only contribute $7,000 a year max. Well, this doesn't have those limitations on. You can contribute as much as you want. You want to put $100,000 a year in, you could do that, right? Roths are 59 and a half, or later taken out without penalty. Well, you don't have those penalties with this. People say, well, but I'm too old, Andrew. Well, we do this for 70-year-olds and 80-year-olds. Are you, so, no, you're not too old. But
no, 10 years before retirement is a really good time. I mean,
right.
Kids, like, you got these for us as kids. My brother Matthew's done special things with these as kids, but like 10 years before retirement, 5 years before retirement, they work really well because we talk about that three-legged stool, and these can add a fourth leg to your stool.
There you go. Exactly. Income, guaranteed tax-free income come out of the thing. Well, boy, here we are. Time for another break. Giving away this book today, Understanding Specially Designed Life Insurance Contracts by John Moriarty. Good book. You're going to learn stuff from this and understand some of the intricate pieces if you want to. But it's only 100 pages, so it's not a big deal. There's charts and examples in here and strategies for how you can use this. 800-725-7616. 800-725-7616. Get your free copy of this book. We're not trying to sell you anything. We're just trying to help you understand, because people don't know what people don't know. You listen to Financial Strategies with Andrew Daniel Agemy. Today's topic, how life insurance really works. 800-725-7616. Call now.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Dad, I was thinking about earlier when you were talking about the different types of life insurance contracts. how there's different designs, there's different types. And you were talking about Wall Street, how Wall Street, um, they wanted to get their hands in this, and they made their own product, right? They made those variable annuities, and there's
Right.
usually a lot of fees. All the normal things we talk about Wall Street are associated with that. But
Right.
on the other side, banks like to get involved with these
Right.
things too. And we
Right.
had someone who became a client and came in and showed us this policy that he bought from the bank. And he said, Andrew, Daniel, did I do a good thing here? I bought this whole life insurance policy. And the bank, the person at the bank was a salesperson. Maybe they thought they were doing a good thing by
Right.
selling this to them, giving them
Definitely.
death insurance, right?
Yeah.
It
Right.
was a whole life or universal life policy, but it died.
Mm,
If you looked out in
right.
the history, he put more money into it, and each year it became a little less valuable, a little less valuable, a little less valuable.
Right.
There's probably a nice person that did this, but they
Yeah.
didn't understand. They didn't have the right tools. They worked for a bank, and that's not what banks do, right? A bank
Right.
doesn't have that fiduciary responsibility.
Right.
Not a lot of life insurance salespeople. There's not a lot of people in the business who
Hmm.
do life insurance that are also fiduciaries.
Right.
Um, but anyways, what ended up happening was we were able to restructure this and build a specially designed life insurance policy for this gentleman
Right.
that now is growing at 5%, right around 5% a year.
Right.
So it went from dying over
Right.
time to
Yeah.
the death benefits increasing. It's got some other benefits on it, like a long-term lookalike, long-term care
Hmm.
lookalike, some other things, and it's increasing. So this year markets are down, the account is up. 5% sounds nice when markets are down 20% year to date.
Yeah.
I'm
Yeah.
Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy because people don't know what people don't know, and somebody's got to tell them. So here we are. Today's topic is how life insurance really works. And Daniel, that's great that you're talking about that. The with that client and the difference between like these salesmen out there, people that go by the suitability standard. Sure, that was suitable for that man, and so the bank sold it to him because it was suitable, but a fiduciary couldn't sell that to him because it was in his best interest. What we got for him was in his best interest after looking at his whole portfolio and analyzing everything and how it works together to understand what the best thing was for him. And that's really key whenever you're looking at finances. Are you working with a fiduciary, a true fiduciary? Because there's people who say they're fiduciaries, but they're not true fiduciaries. And then, or are you working with a salesman from that standpoint? But you know, what we're talking about today is how life insurance really works, and we're talking about policies that will be there for your whole life, the rest of your life. They're permanent policies that have cash value to them that you can use. Now, we're not talking about your father's life insurance policy. Okay, we're talking about a specially designed policy, a policy that fits you, and we're not promoting this from our standpoint. We're just educating on what we're talking about. So if you're going to look at a specially designed life insurance policy, it's one that fits you with all of your parameters put into place and taken in place. I talked to somebody recently that liked this whole concept and was trying to find out if it was working for his good. And I said, well, we have to look at all the rest of your finances to see how you're going to fund it and how it's going to happen. And he just couldn't get out of his mind that he's just looking at this microcosm of this policy without the whole picture. And the whole picture is really key to it because so many times, when we're designing these for people, we'll take money out of one pocket, put it in the other pocket, and it's still there and it's working. It's just multiplying and compounding in how it works. So it's just not like Daniel said earlier. We're not talking about a product. We're talking about a strategy that fits to be able to get guaranteed income tax free for the rest of your life.
Exactly. And in this story, in this scenario, uh, we were able to move it from, as you're calling it, your father's life insurance, one that wasn't designed for this individual is just an off the shelf product that was not really, it was going to die
Yeah.
over time. And that's one of the cool advantages of these whole life insurance policies. You can move it into something else that is specially designed, and you don't have to give up maybe the money you put into it or things like that. So second opinions are really important with these things in order to understand what you have and if it's working for you or it's sucking money out of your pocket, right?
Right. Right. And, that reminds me of the one client that had come in. She just retired, and she came in, I don't know, a year or two ago, became a client, and she had done a policy like 20, 30 years ago with her father-in-law. And, it was a different company then. The company now stinks. It basically went bankrupt, and they're still around under another name, and it's not working well. And so we were able to take that and convert that into a specially designed policy that is going to work better and is working better for her, and on a tax-free nature, and helping her to be able to retire in the fashion that she wants. And there's just so much, Daniel. This is where I start talking about diversification, right? But anyway, we got a white paper. We got a paper to get goes along with today. So one of the aspects of these specially designed life insurance policies is that they can provide a long-term care feature on them, so that you can use this money. Your money is bumped up for long-term care purposes, and you can take it out on a tax-free nature for long-term care. And who wants to go into a long-term care facility? Nobody has that on their bucket list. You want to stay home as long as you can. So this will allow you to stay home, and it's an extra piece, icing on the cake, depending what company you use, it a lot of times at no extra charge, as opposed to a traditional life long-term care policy that you die and it's all gone. And all that money you spent is nothing, just like your car insurance. This one, you're going to get your money back one way or another. But we have this paper today called "Don't Let Long-Term Care Be Your Financial Blind Spot." So just ask for it by name, long-term care paper. Call us at 800-725-7616 to get your free copy of the long-term care paper. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic: how life insurance really works. Daniel, diversification is important in anybody's portfolio. Can you explain how a specially designed life insurance policy for our audience works so beautifully?
Yeah, well, diversification's a funny thing because a lot of times when financial people are talking about diversification, they're talking about like diversification. So buy a bunch of mutual funds that own a bunch of different stocks. And that's a type of diversification, right? You spread your risk between a bunch of different companies. That is diversified between company risk. So if one goes bankrupt and you own 700, it's not really going to affect you.
Right.
But that's not market risk. All those are going to do the same thing. All 700, you're not diversified from market risk, right? Or systematic risk.
Right.
It's all correlated. It's going to do the same thing. Those 700 companies are going to do the same thing. Now, where people get even tripped up more with diversification is they will buy 700 mutual funds, or their advisor will buy them 700 mutual funds, and they all have 10% Apple, 10% Microsoft, and 10% Google in them. So even though they have 700 mutual funds, there's still 30% in three companies or something like that, right?
Right.
So true diversification comes in when you're able to have uncorrelated assets or negatively correlated assets.
Yeah.
Right. So how a cash value or a whole life insurance policy can benefit someone or give them diversification is when markets are down, you actually are earning money, right? Your money stays flat. It gives you all the optionality in the world because now you can say, I would like to participate in these cheap stocks.
Right.
Right. And you could take the money out on a tax-free basis. You don't have to worry about capital gains. You don't have to worry about any of these things. And you can purchase your stocks cheap.
Right.
When you want, which ones you want. That's real diversification. When markets come down and your stuff doesn't come down.
Right.
That's one way it provides diversification. It does a
Mhm.
lot of other things
Mhm.
where um, it gives you those benefits you were talking about. So
Mhm.
like uh, there's third and fourth order consequences, right? So what if you say, well, markets average 9%, right, over 150 years.
Okay.
So that's going to be my long-term care benefit. Well, what happens if when you need the long-term care monies, markets are not doing 9%, they're actually negative 40%.
Right.
Now you're cannibalizing your money,
Yeah.
right?
And run out of it.
And so that's another way that it provides diversification because you have a bump up for long-term care benefits on the one side,
Yeah.
whereas you have a minus 40% return, or some people say, well, markets are never going to go down 40% again because the Fed's got our back.
Right.
First off, they told you they don't have your back anymore. Second off, okay, use 20%. Try to recover from a 20%, a negative 20% if you had to take $150,000 out for long-term care purposes,
Right.
right? That's one way. It also, if you have a pension and you have a pension that goes better, Social Security is not what you need for enough
Yeah.
for what you need for, or other unforeseen events happen and you need more income.
Right.
These have the ability to turn on an income stream to you. That's another way of diversification.
Yeah. Yeah. It's the whole basic premise of investing is buy low, sell high. That's what Walmart does, and everybody that sells stuff, that's what they do, right? They buy things, on wholesale, they sell it for retail, right? And that's how to invest. Buy low, sell high. So, this is a beautiful thing because the insurance is not decreasing in value when the markets do. So then you can take out what's high and buy what's low, so that when that what goes up can be then taken out and put back. And we'll tell illustration of one of our clients that did that when we come back after a break. But we need to take a break, and we love to give you this book by John Moriarty, our friend, Understanding the Specially Designed Life Insurance Contracts. Again, like I said at the top of the segment, this is not your father's life insurance. So we'd love to put this in your hand for free. 800-725-7616. No obligation. Enjoy, educate yourself so you can make smart decisions. 800-725-7616. We'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So I love being able to tell this. So, when we're talking about this is not esoteric stuff. This is stuff that works. I mean, politicians use this stuff. I use this stuff. I bought this stuff for my kids when they were small. As they got bigger and adults, they saw how this worked really well. So then they went out and they bought their own policies and such to be specially designed insurance policies. And now I'm buying this for my grandkids from that standpoint. But the beautiful thing is one of my kids took his money, put money in, and then was researching stocks and decided he was going to buy Tesla. Bought Tesla at a very low price compared to what it's worth today. Put the money into Tesla. Tesla went up and he doubled his money. Then he took the money that he had originally invested out, put it back into the life insurance contract. And then now he's got all this Tesla stock that he's got for nothing at this point. And his life insurance is growing and Tesla stock is growing. And then he took more money out of the life insurance policy and he buys, and this is not Daniel. Daniel does other stuff like this too, but this is not Daniel, just so that you know. And then he takes other stuff. He invested in other things like Bitcoin and other things that he is 10xing and 20xing his money on and multiplying it 10 times, 20 times, that kind of thing. And it's just a phenomenal. So it has become his opportunity fund that he has that money sitting there waiting for the opportunity, whether he wants to buy a car to redo, or he wants to buy a stock to invest in, or whatever it is. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about what is life insurance. And that I love that story too. We talk about planning for unforeseen events all the time. And that's really important. That was the whole thing about the JP Morgan quote right at the beginning of the show is, making sure you're not making your decisions based off your neighbor getting rich, and you need emergency funds. And some people don't have any emergency funds. Some people have emergency funds, but it's kind of hard to get, or there's consequences for taking them. And some people have emergency funds that are sitting in it. They got a lot of money in the bank and it's rotting. It's literally like taking your money, putting it in your backyard, opening up the back fence and lighting, 8% of it on fire each year. Right.
Yeah. Right.
So that story you told about, he had been buying stock, but then Tesla got to a ridiculously low price where it was priced to bankrupt. And he had to say, well, either they're going to go bankrupt or they're not. And I've been spending all this time studying them, and I think not, right?
Right.
And so that's when he decided to tap into his opportunity fund, put it in there, and 20x it. Right. I mean, like, that's ridiculous. So that's a great story. But people do that with buying cars, with buying houses. We see clients use this stuff for all these types of things. To right now, rates are high, right? Mm-hmm. So you could take this money out of your life insurance policy to buy your house if you got a big cash value, or you could get a 6.5% mortgage.
Right.
It's just the opportunity that it presents for people that build them properly.
Yeah.
Which I'm going to ask you in a second is amazing. So tell us the difference between specially designed life insurance and regular life insurance, or your father's life insurance, not my father, obviously. Your father's life insurance, right?
Right.
Because this is a real thing. It's not like we just made up specially designed life insurance, but there's a key difference between this and like what the guy that we talked about who bought his policy from the bank had. Right. That was an example of your father's life insurance policy or a salesperson policy. It's off the shelf. Why is especially not off the shelf? Well, why is it different?
Yeah, well, some of the big differences are how policies worked in the past was, you put in your money and it was primarily, it would do all these things we're talking about, but most of the benefit was toward the death benefit side. And there was cash there, but it was minuscule. So it was more of a death benefit policy, although there did have life benefit. The biggest easiest way to explain this is it has lesser death benefit and more life potential. So let's just say you put $1,000 a year in your father's life insurance policy, and maybe 700 of that goes toward the death benefit, and 300 goes toward the cash side of things. You put $1,000 in a special design, a customized to you policy, and maybe it's just the opposite. 700 goes toward the cash and 300 goes toward the death benefit side, right? I mean, it is life insurance. I mean, in 1987, they changed the laws so life insurance could not be, quote unquote, an investment anymore. Prior to that, you could take 100 grand, put in a life insurance policy, grow tax free, do all this beautiful stuff, have no issues. But then they came out with what's called modified endowment contract to keep people from investing into life insurance. And, it changed the rules, but there's ways to get around it. There's particularly one company that has a fantastic way of getting around that today. So, but whether or not that works for a person depends upon their own situation. That's where the customization comes in.
It made it a lot harder to participate in
Right.
and get the full benefits, because you have to
Right.
be more creative and customized. And that's part of a difference between your fathers, as you're saying, and especially design. People had to learn how to adapt to that and change it to be able to create more living benefits.
Right, right, and less taxation, right? So you're exactly right. But I see that it's time for me to identify ourselves financial strategies. And Andrew and Daniel Agemy, how life insurance really works is today's topic. We have a paper to give to you. This is long-term care. Don't let long-term care be your blind spot. And we love to put this in your hand. And especially design life insurance policy can also help with the long-term care side. Call us at 800-725-7616 for your free copy of long-term care paper. And we'd love to send that to you. Daniel, this is significant because where I was going with that was the aspect of, many times people say, why haven't I heard about this before? Why is this something new? No, this has been around for 150 years, but customization of it is something new. But nevertheless, the politicians in Washington know about this stuff. You can bet that they have it in their portfolios. There's companies out there that promote buying term insurance and investing in rest, whereas the president of the company has this kind of insurance in his portfolio. So this stuff is out there. They reward presidents and corporate and CEOs of companies with these things as part of their packages that they put together. There's lobbyists. This stuff is so good that there's a certain factor in Washington that wants to do away with the tax-free nature of life insurance and all these different things that are available to people. And if that ever happens, it's going to be horrendous to our country as far as what this is doing. Daniel mentioned earlier this, he didn't say it exactly in this way, but this stuff is a beautiful emergency fund is what we're talking about, because you can get your money out on a tax-free basis, not have to worry about taxes, and we can get you money within a week or two, tens of thousands of dollars if you needed it, and then you can put it back in if you want it. So it's a great be your own banker kind of thing, which is another topic. But what I'm trying to say is, people say, why haven't I heard about it? Well, because it's one of the best kept secrets out there. Politicians, they don't want everybody to know about it, because then the more people know about it, there's going to be more people that come against it and say, let's do away with this and get more taxes for the IRS. But there's a great lobby within the life insurance industry that's keeping that from happening. But with that, I got to believe that the politicians in DC that are using this stuff don't want that to happen either. So they're keeping it on the keeping it best they can on the still and going in the direction that they need it to go in. But
And when you're talking about politicians, we're talking all the way up to presidents of the United States.
Right.
Like these, I actually don't know off the top of my head. It'd be interesting to find out how many U.S. presidents had huge policies in this, but these recent ones definitely have had huge amounts of money in these exact things. So yeah, it goes all the way to the top when you're talking about the politicians understanding these.
Right. And the unfortunately in our country, it seems like the politicians, they got everything working for them, and everything's different and better for them, right? They've got inside trader opportunities that we can't have. They've got health insurance that we don't have. They got pension plans that we don't have or can't have, right? And they've got all these special benefits. And this is one of those things. And you haven't heard about it, but if you research, I'm sure you can find out on the internet how the politicians are doing this stuff and using these things. But it's great opportunity for people. And our job is to educate people on what opportunities and what they can do. Their job is to make the decision, decide if they want it as piece of their portfolio.
Right. And this isn't available for everybody.
Right.
Not
everybody qualifies.
There's certain requirements that people have to, health requirements and things like that people have to meet. And that's partly why it's selective. But I like the fact that how you explained the specially designed part. It's adding a lot of living benefits, like waiver of premium, right?
Yeah.
Where if you're totally disabled, the company will pay your premium, and these long-term care benefits or chronic illness benefits. The death benefit is like free if it's built right. That's just icing on the cake, and people use that to cover taxes,
All right.
right? Because that's a tax-free inflow of cash. So people are able to pay different taxes, whether that be you got a lot of IRAs, and so this could cover the tax when you die on cashing out the IRAs, or it's estate taxes, or it's housing tax, all kinds of things that you can use these for. But I think the key part there is the specially designed part means that it's
Yes.
totally customized to your situation and what you need. If that's
Yeah.
an emergency fund, if that's a tax-free inflow of cash, if that's long-term care benefits, or that's trying to build a huge cash value so you can use it as an opportunity fund. The specially designed part means it's customized to you as an individual, not off the shelf.
Right. Right. Exactly. And you've been listening to Financial Strategies, Andrew and Daniel Agemy. I've had a lot of fun today. I hope you've enjoyed this, and I trust you've it got education and information that you wouldn't have had otherwise. Hopefully, it's enough to help you make a smart decision, or at least know what questions to ask. Before we get off the air, I'd like to give you this offer our book again: Understanding Specially Designed Life Insurance Contracts, customized contracts that are Roth lookalikes on steroids, to be able to help you to attain your goals in this life. All right. And it's not about the death benefit as much as it's about the life benefits. Love to put this copy in your hand. 800-725-7616. Call for your free copy. If you want a stress-free retirement, invest for the I and not the G.